I don't see anywhere you can be safe right now.
Hello everyone and welcome to the Daily Crypto. We are back with another informational video for you guys, and this time we have Mr. Wonderful Kevin O'Leary with us. But before we can listen to what he has to say, let's take a look at the Fear and Greed Index for today. As of recording this video, it is at 23, same as yesterday. Currently, Bitcoin and Ethereum are trading for $19,430 and $1,327 respectively. With that being said, let's get started with the interview.
A highly unusual situation going on here, given how much the market is corrected, anticipating slowdown in earnings and a recession and a Fed gone wild with another 75 and potentially another 75 after that. None of these rate hikes have affected the consumer yet, and I speculate it's for one singular reason. No economy has ever printed $6.72 trillion in 30 months. That's basically turning on the printing presses, printing money, giving it away for free, dreaming up other reasons to give more money away for free, such as student loan forgiveness, and then the Anti-Inflation Act. That's just hilarious to call it that. It's very inflationary. And so at some point, we'll have to stop printing money, but it hasn't happened yet. All-time record deficit, consumers flush with cash, and these earnings are proving it out this week. If we're going to get a slowdown in earnings, it's probably going to be in Q1 or 2 next year, because it doesn't look like it's going to make it this quarter. And as a result, we've got a really perplexing, difficult time for investors.
With the Fed hiking interest rates by 75 basis points 3 times in a row, it is being speculated that we could see another 75 basis point hike in November, which will put the markets under more pressure, resulting in the stock market and risk on assets taking another hit.
Well, the inflation fears come from the CPI number, which was over 8%, and that is inflationary. However, there's a new narrative going on in the market with investors regarding how the CPI is constructed. 40% is in shelter. And shelter stats are notoriously long dated. In other words, the numbers you're seeing now reflect the shelter market, the housing market, the apartment rental market 18 months ago, when it was smoking hot. That is not the case in major cities now. Rent increases have slowed down, housing prices have softened as mortgages have increased, and yet it's not reflected yet. So it's a little bit of saying, I want to change the data set now because I don't believe it anymore. That's kind of one narrative. But even though it's sitting at over 8%, the market is willing to fibrillate, waiting for more earnings validation that we actually have a slowdown. It's simply not there yet. And so if the Fed keeps using this 8% number and keeps ratcheting rates, they will overshoot.
The rising inflation concern is because of the CPI number that didn't come out as good as expected. With inflation still sitting at around 8%, the Fed will have to do something to curb it and bring it under control, otherwise jobs number will be negatively affected, adversely affecting the economy.
Recessions start traditionally with a rise in unemployment. Haven't seen that yet either. If you're in the food services industries on either coast, where in California, for example, the minimum wage is $15, you can't even hire people for $23 an hour now. They don't even want to work. So that cash that's flushing around the system is still having an effect there. It's not clear how the poo-poo hits the fan on this one yet, but the market has made a decision. The corrections in the S&P 500 have been brutal and fast in every single sector. And so the market, generally speaking, is never wrong forever. And what it anticipates is a sharp decline in earnings, because right now the PE, if we believe the earnings for next year, is sitting between 14.5% and 15%. Well, that's getting close to a bottom. I mean, you could argue the bottom would be 12x, which is really, really low earnings for the S&P. But here we are at 15. I mean, I'd argue it's time to start nibbling. You can't guess the bottom, but my goodness, just on a strong index basis, you could go into this market saying to yourself, regardless what the correction is, 2/3 of it's baked in.
Since it will take some time for consumers to be affected by the interest rate hikes, Kevin says it is about time before we see people struggling to afford their lifestyles. Many people will become unemployed because that's just how inflation and employment are inversely related.
Well, Biden has to talk his book because he's only weeks away from a midterm where he's threatened right now to lose the House. Nobody knows what's going to happen in the Senate. What they wanted to have happen was that there's some indication of a slowdown in inflation. They didn't get that. And their gas prices in some states are on the rise. That's never, ever good for the incumbent, regardless of what party they're in. inflation really kills you at midterms, and that's what they've got. So also, if the Fed raises another 75 basis points before, which they will do before the midterms, that's not helpful either. So it's a really difficult act that he has to, a higher wire act he's got to do. Biden's got to talk his book and try and keep as many of his candidates in the game as they can. You know, when we talk about politics, abortion was the issue, and that seems to have been shifting now in the last few weeks to inflation and the cost of protein like chicken and food goods and gasoline back in the fray again. So, you know, these things are binary. They're very difficult to call, but it does matter to you as an investor what happens in the midterms. There's no question about that.
With elections right around the corner, all the economic pressure is on Joe Biden because he has to win the support of the people by bringing inflation under control, otherwise his position will be at risk. Kevin believes the Fed will do everything in their power to curb inflation, and a 75 basis point hike is definitely in the cards.
So let's say the House flipped. The good news on that is all new bills, all new initiatives that are not bipartisan bills, in other words, ramma-jamma down your throat bills like the student debt thing, ramma-jamma bill like anti-inflation bill. I mean, nobody wanted to vote for that on the other side of the aisle. So those kinds of bills are dead for the rest of this presidency. There'll be total gridlock. And that is a good thing. The markets love gridlock. Markets like a pause that refreshes. We need a pause. The printing presses have gone insane, and that's why we have inflation in the first place. I mean, for all the talk about inflation, you print $6.72 trillion in 30 months. What the hell did you think was going to happen? Of course there's going to be inflation.
What Kevin is trying to imply is the fact that the Fed doesn't have a lot of options to rectify their mistakes. The best they could have done was to not print $6.72 trillion in just 30 months, because whatever problems we are seeing today are because of the quantitative easing.
But I will say, from an investment perspective, European banks are zombie banks. Their return on assets is abysmal. They never went through the cleansing that the giant crisis in the US occurred in 2008, 2009, where we bailed out our banks, but we also put these really difficult covenants on them in the use of leverage and credit ratios and all the rest of it. So they ended up being much stronger when they were refounded. That's not the case. Bank of Scotland is still owned by the government, which is horrific. You never want a government running a bank. All the rest of the banks in Europe are uninvestable. They are absolute zombie banks, abysmal investments. I mean, avoid with extreme prejudice, absolute, make no money, terrible returns on assets, fat, really bad margins. Everything bad you could say about them, you can say about them, then you should double it. They are just zombies.
While Kevin O'Leary doesn't think that the Credit Suisse bank is at risk of defaulting, he does point out that the European banking system is extremely flawed and inefficient. Since he is an accomplished investor, he knows these institutions inside out, which is why he says they are due for a cleansing like the American banks in 2008.
I don't see anywhere you can be safe right now. You have to kind of tread water. I continue to add in two areas really high quality US S&P 500 companies, of which I buy 100 of the 500 in an index from Alps called OUSA. It's an ETF, anybody can buy it. I'm not recommending it, I'm just saying what I use. And then I use another Alps ETF called OUSM, and that is 200 names in the Russell 2000. So a fraction of the Russell 2000, the companies that make money. My whole thing now is, while I'm waiting in the weeds, is I'm willing to buy companies that are profitable, have high return on assets, and do cash distributions. Everything else I don't want to own, because those are getting absolutely crushed, and the bottom is not in yet. So many companies, when people thought, oh, it can't get any lower, and it goes down another 40, 50%. Yeah.
According to Kevin, there isn't any financial instrument that is guaranteed to keep us safe. However, he does reveal that he has picked up on some S&P 500 and Russell 2000 ETFs, which are made up of companies that he thinks will do good in the future. Thank you for watching this video. Please leave a like and subscribe to our channel because we upload videos like these on a daily basis. See you guys in the next one.